February 24th, 2022. Remember that date? That's when Russian tanks rolled into Ukraine. It wasn't just an invasion, it was a seismic event that shook global markets to their core. Stock markets went haywire. The Dow Jones, the S&P 500, the London Stock Exchange all plunged. Investors panicked. Uncertainty reigned. The world watched in disbelief as decades of relative peace in Europe went up in smoke. The initial shock was most severe in Europe. They're geographically closer to the conflict, which is never great for real estate values. But they also rely heavily on Russia for energy. The German DAX, the French CAC 40, all took a major hit. And the Russian stock market? Let's just say it's currently less of a market and more of a smoldering crater. The US market, while initially less affected, didn't escape unscathed. The reality is, we live in a globally interconnected economy. What happens in one part of the world inevitably ripples out, and the ripples from this conflict were about to become tidal waves. Remember when gas prices were considered high a couple of years ago? Those were the good old days. The war sent energy prices skyrocketing. Oil soared past $120 a barrel. Natural gas prices went through the roof. It was like someone lit a match under the global energy market and surprise, everything's flammable. For consumers, it was pain at the pump. For businesses, it was an energy bill nightmare. Airlines got slammed with higher fuel costs. Trucking companies felt the pinch. Manufacturing became more expensive. Suddenly, inflation wasn't just a scary word economists used, it was a very real monster lurking in everyone's wallets. Energy companies, however, were having a field day. ExxonMobil, Chevron, their profits soared as oil prices climbed. It's the circle of life, but in this case, the circle is a giant oil barrel and we're all trapped inside. Remember the before times, when you could walk into a store and buy whatever you wanted? Pepperidge Farm remembers. The war threw a wrench into global supply chains. Ukraine, a major agricultural producer, saw its wheat and corn exports grind to a halt. Russia, a key supplier of metals like palladium and nickel, was hit with sanctions. The result? Shortages. Prices for everything from bread to cars went up. Remember the great semiconductor shortage? Yeah, this made that whole mess even worse. The auto industry, already reeling from chip shortages, faced even longer delays and higher costs. The world got a crash course in just how interconnected and fragile our supply chains really are. It turns out, when a major geopolitical event disrupts the flow of goods, the ripple effects are felt everywhere. Who knew? So, what's the world doing about this mess? Well, central banks around the globe started raising interest rates to combat inflation. The Federal Reserve in the US, the Bank of England, they're all trying to put the brakes on runaway prices. Of course, raising interest rates can also slow down economic growth. It's a delicate balancing act. Meanwhile, the economic sanctions imposed on Russia are having an impact, though perhaps not as quickly as some might hope. The Russian economy is hurting, the ruble took a nosedive, but the war continues. The long-term economic effects of this conflict are still unfolding. Will the world enter a recession? Will we see a new era of stagflation with high inflation and stagnant growth? Only time will tell. One thing's for sure, the world has changed. The post-Cold War era of relative peace and stability is over. We're now in uncharted territory. The markets and the world are still trying to figure out what comes next.